Everyone. Welcome back to Trading Simplified. This is the part of the show where once again I get amazed at the amount of episodes we've covered so far. Time is really flying. So this is episode 19. So what are we going to talk about? Well, I want to talk about traits of successful traders, and more importantly, how to acquire them, or as importantly, I should say. I hate when somebody tells you about something and doesn't tell you what to do about it. And I put part one in here because I've got a lot to cover and I've whittled it down quite a bit. But each one of these slides I could talk about for probably an hour or so, or maybe even more. By the way, housekeeping, I do take requests. If there's something that you want me to cover, send an email in to the good folks over at StockCharts.com. And as far as reaching me, if you would like the slides from this presentation, if you're watching live, give me about an hour or so. But if you are watching the recording of this, davelandry.com/stock charts, easy for me to say. I'll give you the slides from the presentation and a bunch of other stuff to keep you busy for quite a while, and a lot of videos and all we talked about in prior presentations. And then you can always reach me at davelandry.com/contact. So let's talk about traits of successful traders and how to acquire them. Now, when I got busy working on these slides, I had some slides left over from the last time I talked about this, and I noticed that I'd taken a picture of my glass board. Now, this is my old office. And this was just some of the things that I wanted to cover when it comes to trading psychology. And in addition to all the things you see listed here, I started working on this trading psychology course. And after about 3 weeks of working on it, I ended up with a 14-page to-do list of things that I want to cover. So I've shelved the project for now, but just to show you how vast this topic can be, especially when you get a little deeper into the trading psychology. And what I've been into over the last 7 or 8 years, a little bit more deeper, is on a deeper level, I should say, is the neurology involved too. And that's been really fascinating, and that's kind of been an eye-opener for me. So we're just going to talk about some of these things, the ones that I feel that are most important. And then, as importantly, again, tips on how to acquire them. When I go to do webinars, and the Trading Simplified is a newer webinar that I do now, obviously. But back when I'm still doing the weekend charts, but a lot of times I'd wake up and say, well, what do I want to talk about? And I'm like, well, I'm going to talk about patience. And then I'll go in and find a presentation from a year ago where I was talking about patience. And then I'll notice that there was one from a month ago. And then I'll notice that, wait a minute, that's what I talked about last week. So this is something that I really beat the dead horse on when it comes to trading. And I can't emphasize it enough. In fact, I would take someone who's patient over someone who's smart any day if I had to pick a protege. Now, there's two forms of patience. The patience to wait for your pitch. And that's a biggie. And I see people overtrade, and that's one of the biggest sins that I see. In my trading service, I think I had 3 or 4 recommendations, if that many, in the month of January. And I took a few little ancillary trades, opening gap reversals and all. But overall, I didn't take that many trades. And one of my clients took 159 trades. Well, that's obviously too many trades, and he needs to apply a little Pareto principle and see if he can whittle those down a little bit. Ideally, you want to wait for the so-called fat pitch. Now, I'm not a big sports fan, but I did a little Googling and found out that the fat pitch looks like a cabbage ball coming at the batter, and you have to swing at it. In other words, you have to take the trade as a metaphor for markets when you have that so-called fat pitch type of trade. But it does require a lot of patience waiting for that fat pitch in trading. Now, speaking of baseball, who do you think holds the record for the most walks? Well, that would be Barry Bonds. Now, you could say, well, Barry Bonds was performance enhanced, and you'd be right. But if anything, I think that would make him less patient on the mound. So he's known as the home run king with an asterisk next to his name because he took a few little steroids. But he's also the world record holder for the most amount of walks. The second form of patience is to let things unfold once you take the setup. And I have some really good examples of that in just a minute. And it's hard to sit there and watch the stock day after day after day, or whatever other market you're trading, especially if it's going sideways, or worse, if it's going against you. So we'll take a look at the mother of all don't micromanage examples. This was AUY. This was a gold stock that I recommended way back last summer, right before we got started with these shows. The entry was there, the stock was there. If you go in and watch prior shows, you'll notice that this is a pattern I call a TKO. It's also a pullback. And our initial profit target was up here. You can see that the stock triggered, and the first day we're doing pretty good. We're in the green. But then the next day we give up some of those open profits, begins to rally again, and then it trades mostly sideways, but we're not making a new equity high. So that's September, October, November, going into December. But Dave, why not get out? Well, you put a stop in place, and if you get stopped out, you get stopped out. Sometimes your timing might be a little off, where you just have to be patient. And as long as you're not stopped out, stick with the position. And then the stock begins to rally a little bit. We start making new equity highs again. And then what happens? It begins to sell off again, or at best, trade sideways. And then finally, 4 or 5 months into the trade, it begins to rally again, but not without selling off pretty hard one more time. And then, bam, goes on to hit the initial profit target. So the point I'm trying to make here is a decent trade. If all my trades ended this well, you'd probably never see my fat arse again. But notice that there's a lot of red where you're giving up open profits, and in some cases at an open loss. And I know a lot of people become impatient. I have a Facebook group, and there were quite a few posts here about, hey, is this thing ever going to hit the IPT? And some posts were actually a little bit worse on how they felt about the stock. Now, if you think about it, and I borrowed this line from a book about the Kelly formula called Fortune's Formula, and they were pointing out that with the Kelly formula, which I would not recommend you use unless you're trying to parlay a small account and you're willing to blow it up, which is a whole nother story. That's something I'm actually doing for S&Gs. But before I digress too far, one of the things they said with the Kelly formula, you spend a lot of time being less wealthy. Well, with trend following, and this is kind of hard to wrap your head around and even harder to live through, but you will spend a lot of time being less wealthy. This week, laugh to keep from crying, I have spent a lot of time being less wealthy. So if we take a look at another one of our trades that actually worked out pretty good, and the green is when we're making money, and the red is when we're losing money. So here's our entry, here's our stop. And by the way, everything that I mentioned here, unless I specifically point out otherwise, I have A, recommended a trade ahead of time, and B, actually taken the trade and put my hard-earned cash on the line. So initially, it triggers in, and by the end of the first day, you're actually at a loss. Then you're making a little bit of money. Then you start losing money. You start making some money back. And it hits the initial profit target, but not without a shakeout first, not without selling off hard. First, goes up, hits the profit target. We're making money again. We start losing money on the trade, or certainly not making a new equity high. We finally make a new equity high. And then what happens? We lose money for the most part because we're not making a new equity high. We start making a new equity high again. Start going sideways again. Barely make a new high, start selling off. Go on to make new highs and then sell off again. Now, the point here is the tremendous amount of patience that is required in trend trading. It took 3 or 4 weeks to hit the initial profit target. And then the stock traded mostly sideways for months. Now, notice that this is a profitable trade, okay, but there's not a whole lot of green, meaning that in this particular case, in this figure, you're not making new equity highs. Now, what's fascinating about this, and again, as I said a little while ago, I'm getting more and more into the neurology of all this over the past 7 or 8 years, and that's based on, I was speaking at a conference in San Francisco about 7 or 8 years ago, and Denise Shaw was there, and she talked about the fact that you cannot eliminate emotions, because if you had no emotions, you would be institutionalized. And the poor people who've had serious injury or some sort of illness that affects the parts of your brain, specifically the amygdala, but there's some other parts that cause you to make bad decisions because you don't have the emotions. They these people end up institutionalized because they can't make any decision whatsoever. Now, anyway, before I digress too far, the neurology of all this is that a negative emotion has twice the impact of a positive one. So if we get back to this PLMR trade, which is still open, by the way, this was a positive trade. And here was the original recommendation on that, as you can see. And this is based on a hypothetical 100K account. Now, I actually do take the trades, but the tracking of the trades is done on more of a mechanical basis. So you could see on a net basis, if you forget about all the zigs and zags in between, getting in at 40 something dollars a share, and the price at least a couple of days ago up around 60 bucks, I'm sorry, 50 something bucks a share, is a positive movement, obviously, and you're making money if you look at where you were and where you are, and not everything in between. But if you take into consideration that negative emotions are have twice the impact as positive ones, you could see that there is a negative spiral that you could possibly end up in. Even though you're doing well in the markets, you could feel pretty bad about the trade. And this was a bit of an epiphany for me. And now I know why I get so bummed out in trades. And if you're watching the screen, more often than not, the market will move against you. Greg Morse once said that markets, and I'm assuming he's talking about indices, but you could transfer this into individual stocks to some extent, only make new highs about 4% of the time. Well, you can see in this chart right here, even as this fantastic looking stock, most of the time was spent backing and filling, and very little time, the green bars, were spent at new highs. So even on good trades, you can end up feeling pretty bad about the trade. Steve Pressfield wrote a book called The War of Art. If you go to this URL at the bottom, davelandry.com/books-2-read, you'll get a list of books that I would recommend you read. Some of them are directly related to trading. Some of them are more ancillary in nature, such as this one. So his book was The War of Art, kind of a play, obviously, on the art of war. And he talks a lot about resistance and any act that rejects immediate gratification in favor of long-term growth, health, or integrity will elicit resistance. And you're going to encounter a lot of resistance when it comes to trading. It's very hard to sit tight. And it's also hard not to micromanage. And it's also hard not to try to make things happen. So again, the patience to wait for setups and the patience to wait in setups. I put out a post a while back because I waited and waited and waited and waited. And a couple of really good trades came along. I took the trades and did really well on them. And I'm like, this trading thing is so dang easy when I just wait and wait and wait and wait. Now, when we get back, we'll take a quick break here. When we get back, I want to talk about acrasia and how the short term really affects your longer term, especially when it comes to trading. Okay, and we're back. And looks like we got a question over the break, Rachel.
Yes, we did, Dave. The question is from Aaron, and he asks, is there an early market tell if this is a pullback or more?
I don't know. you won't know until you know. As far as this being a correction that we're in, yeah, I'm not sure on that. You just have to honor your stops on individual on your individual setups. One thing that I'm paying attention to is the TFM 10% system, which we talked about in an earlier show. And if you need the slides on that, they're in the list of slides that I send out. And if the market drops 10% or more from its closing high and then if we go, in addition to that, if we go below the 50-week moving average, then I would be really concerned about this market. But I guess the answer question, yes or no, so far it's just a pullback, but stay tuned, obviously, and honor your stops in individual positions. Okay, when we left off, we were just getting to acrasia. Acrasia is a state of mind in which someone acts against their better judgment through the weakness of will. And this occurs quite often in trading. So again, you have to be patient to let the market come to you. And then once you're in the market, you have to be patient for the market to move. So again, I think if you just had one trait to become a great trader, that trait would be patience. Now, the only problem with quoting Livermore, and I know I've got about a dozen slides with him in here, is that once you start quoting him, very hard to stop. And obviously, I think anyone who's been trading for more than a day has read Reminiscence of a Stock Operator. And Livermore kind of talks about both. He says, it was never the thinking that made the big money for me. It was always a sitting. Money is made by sitting, not trading. I often joke that we're more waiters than we are traders. Don't give me timing, give me time. Let the market come to you. I think it's what Mr. Livermore is suggesting there. A man may see straight and clearly and yet become impatient or doubtful when the market takes its time about doing as he figured it must do. The market does not beat them, they beat themselves, because though they have brains, they cannot sit tight. I have an example here I want to show you in just one second. And many times I'm tempted to just exit the market. I was very tempted on Monday to get out of all my positions, and then on Tuesday, kicking myself in the butt for not getting out of all my positions. But instead, what did I do? I followed the plan. And I think that's one unfair advantage I have being in the educational business is I have to practice what I preach. So if you go back to last summer or mostly any summer, markets tend to chop around quite a bit. So for trend following, if the market is going sideways, notice we were around 2,900 and we ended the summer and early fall around 2,900. The market is going absolutely nowhere. So there weren't a whole lot of trends to follow. There were a few setups in between, but for the most part, the market just kind of chopped sideways. So that waiting a lot of times involves waiting for the market to move. Now, someone asked me about this stock just yesterday. So they wanted to know if it was a TKO. Well, yeah, you've got a nice little TKO move here, but what are you knocking out? This stock has spent months and months and months and months going sideways. And on a net basis, it went from about $27 a share, give or take, to $27 a share, give or take, on 1, 2, 3.5 months. So it might be a knockout move, but it's not really knocking out a trend. And if you take a look at the S&P 500, going back a couple of days, obviously, and you go from October to now, you can see we've been in a really, really serious trend. Now, here's a lady that was looking at a stock that has gone absolutely sideways for months and months and months. So if the overall market looks like this, the point I'm trying to make is that you could probably, through being patient and doing your homework, you could probably find a stock or stocks that look a little bit better than that prior one that's traded mostly sideways. Now, one thing that I've asked 1,000 times in webinar after webinar is, why do people who are successful in life deal in mediocrity? And I just would say it time and time again and never got an answer. Then one day I got an email from somebody, very long and eloquent email, and I've talked about this particular thing before, and it was from a psychiatrist who's also a client. And to kind of sum it up here, because again, we could talk about any one of these things for hours. she said that if you're a doctor, a lawyer, or an automatic transmission mechanic, you can't sit around and wait for the perfect client. Just like as a trader, we sit around hopefully and wait for the perfect trade and then take it. That's at least what I'm preaching, and that's what I attempt to do. But if you're in one of these professions or any profession other than trading for that matter, you just can't sit on your butt. We're just not trained to do that, or those professions, I should say, aren't trained to do that. So it goes against human nature. And that's why so many people try to make something out of nothing with trading and pick these stocks that have gone sideways for months. Now, during less than ideal conditions, you keep yourself extremely busy outside of the markets. That's why I'm doing a webinar, or I do these webinars, I should say, for StockCharts.com. I do my own webinars every Thursday. And just in preparation for them before this webinar, I was like, sometimes it takes me 2 or 3 days to put together the slides for one of these webinars. I know, believe it or not, I do prepare. But it takes a lot of time. And that time, every moment I'd spend doing these webinars or preparing for them is one less moment that I'm watching a screen and would be tempted to do the wrong thing. Ed Sakota once said, having a slot machine on your desk having a quote machine on your desk is the equivalent of having a slot machine. Sooner or later, you're going to want to feed it. So I take a can't stand it test. If I just can't stand it, then I'll take the setup. So you have to ask yourself before you put capital in harm's way, do you really think you have the mother of all setups? On anything less, you need to pass. And there's Mr. Livermore once again. I let the craving for excitement get the better of my judgment. The desire for constant action, irrespective of underlying conditions, is responsible for many losses in Wall Street. Coming into today, I don't have any setups that I feel worthy to trade. Okay. I had a few stocks that have pulled back that look pretty good, but I was like, you know what? I don't think it's worth going after any of these setups, especially in light of the overall market conditions. The desire for constant action, irrespective of the underlying conditions, is responsible for many losses in Wall Street, and even among professionals who feel that they must take home some money every day as though they were working for regular wages. Again, as a trend follower, you're going to spend a lot of your time, probably most of your time, being less wealthy, and then bam, you hit it out of the park. You get a big winner. You get a stock that doubles over a weekend or doubles overnight, and you're doing fantastic. In the meantime, you grind it out, grind it out, grind it out. Someone in Market Wizards was saying, life of a trader, 3 months you're hot so hot you can't sleep. 3 months you're cold, so cold that you can't sleep. And then the other 6 months, you make a little, lose a little, and just barely keep your head above the water. Well, that's trading. And the other thing too, just not to get too far sidetracked, imagine that, me going off on a tangent. There's no such thing as an income producing strategy. Well, Dave, what about selling options? Yeah, well, that'll work until it don't. You'll make a little, make a little, make a little, and then blow up. And psychologically, it's very tough to trade like that. You feel pretty good for a long time until you blow up. Pure reversion to the mean trading, who I pick on those guys a lot. I probably shouldn't pick on them because I get more pure reversion to the mean traders, meaning people just buy oversold or sell overbought, than any other trader. Now, here's the clincher. Remember this, when you are doing nothing, those speculators who feel that they must trade day in and day out are laying the foundation for your next venture. You will reap the benefits from their mistakes. So let's say a market starts going sideways in basis. Well, if you just sit on your hands and let that unfold, I used to say the bigger the base, bigger the launch into space. And then I learned that it was Ralph Akampora that actually said that long before me. It's kind of interesting. I'll say something and then realize somebody said it long before me. And then I'll read one of these books that's 100 years old or 150 years old and realize that somebody actually said it before them. So there's nothing new under the sun. And I think Livermore talks about that too. But the bottom line is those people who are in and out, in and out, in and out, like the rat trying to get his little cocaine fix, are actually laying the groundwork for you, provided, of course, you can be patient enough and wait for it. And again, once you start quoting Livermore, very hard to stop. The reason is that a man may see straight clearly and yet become impatient or doubtful when the market takes its time about doing what it figured it must do. Look at that gold trade we sat in for 6 months. Believe me, it wasn't easy, but I just said, well, let's just forget about it, put a stop in place, Get stopped out, get stopped out. If not, the market might take its time doing what it has to do. The market does not beat them, they beat themselves. Think about that, okay? The market doesn't beat you, you beat yourself because though they have the brains, they cannot sit tight. Old Turkey, they called him Old Turkey Neck, and he was bullish because the market was going up, was dead right in doing and saying what he did. He had not only the courage and his convictions, but the intelligent patience to sit tight. Patience to sit tight. Disregarding the big swing and trying to jump in and out was fatal to me. Nobody could catch all the fluctuations. In a bull market, your game is to buy and hold on until you believe that the bull market is near its end. I am 90 something percent long, even still, in my accounts. And if I get stopped out, I get stopped out. That's the market telling me that the bull market may have come to an end, at least on my individual positions. Now, one thing I often say, and I'm sure somebody said it long before me, but there's always a reason to exit a trade and rarely a reason to stay. Bill Dunn once said, riding a trend is like riding a bouncing Bronco. I was reading a book by Stanley Kroll last week, and I noticed that he said the same exact thing. So the market will try to shake you out of a position. And you could argue why you should exit that position. But unless you're stopped out, you need to follow your plan and stick with the position. Now, good traders hold themselves accountable. Ein Scheiten von Schweihandlern, and I butchered that German pretty bad. But if I got my translation right, that's a story of two traders. I was in Germany a few years back speaking, and there was two traders. One was very successful and one was losing money. Did one have a better system over the other? No. They were both trading the same exact system. In fact, they were trading partners. One was doing well, following the system, while the other was second guessing the system. All he would have to do would be to follow the system. So a lot of times, if you're not fortunate enough to have a successful trading partner, a lot of times just hold yourself accountable and follow the system and don't micromanage yourself out of the trade. Robert Rotella from Rotella Capital Management, he wrote a good book. Years ago, he wrote a book called Elements of Successful Traders, and I liked it because it had a really good psychology section. The technical analysis in there didn't really strike a chord with me, but I later found out that Mr. Rotella was actually having some issues of his own, was in a big drawdown, and a little depressed about his trading when he wrote the chapter. And I think it's very heartfelt, so I would recommend you read that, and you can go to Books to Read on that. And here's the thing, you do not have to explain the reasons to a higher official to escape censure. You have a far harder task. You must instead justify your actions to yourself. There's no way to hide when trading because you always stand alone. Well said. So accountability is a really big thing. So if you find yourself not holding yourself accountable, would you be brave enough to have someone else hold you accountable? Just like the two German traders, if trader B, the bad trader, said, hey, you know what? I'm not really doing so well following this thing. Can you help me follow along and hold me accountable? Then I think that you would be much better. And I have quite a few anecdotes on this, and we'll get into these next week since we're out of time. But if you need to reach me, www.davelandry.com/contact. And I want to thank everybody for attending. Thank you so much.